I was a kid, my mum always said that if she won the lottery, she'd put the £1 million in the bank and live off the interest. And back then it was a very sensible idea. In the 1980s, the Bank of England base rate, which directly affects mortgage interest rates, was quite high, very high, in fact between 8.5% and 17% at one point, which meant in turn that savings rates ranged from around 6 to 13%. So that £1 million in the bank would have earned interest of at least £65,000 a year, which was much, much more than our household income. Times have changed a lot since then, and if you left that £1 million in the bank now, it would probably earn you somewhere between £100 and £1,000 interest per year, and no, that's not a mistake. Compared to the £65,000 you used to be able to enjoy, it's tiny. So why don't you get that level of interest on your savings these days, and why does that matter? Is this a problem you need to know about? Well, if you want to know more about this and how to make your money work for you, don't forget to hit subscribe. Hi, I'm Claire, money coach and qualified financial advisor. For the last 14 years, I've been working in the financial services sector, and I run a successful financial services business. I'm here to help you walk into wealth enriched, empowered and excited. I've built my dream life, and now I'm going to help you build yours. And remember, if you have any questions, post them below, because at the end of each video I answer one viewer's question. Okay, let's get on with today's show. Interest rates are at a historic low, which is great for those of us with mortgages. Just imagine how high your mortgage payment would be if rates were like they were in the 1980s. A payment that you'd pay £800 today for, in the 1980s you'd be paying somewhere between £1,300 and £2,800 a month. But that also means that savers don't get a decent return on their savings. Why? In simple terms, the money that savers deposit in the bank is used to lend out to mortgage borrowers, and the lender passes on a share of the interest as a reward for leaving your money on deposit. Except they're not getting much interest in the top end due to those low interest rates we talked about. So they choose to pass very little of it on to you, like 0.1 or 0.01%. So living off the interest if you win the lottery now, even if you won 14 million, just isn't going to support your lifestyle unless you can live on £1,400 a year. And that's before we consider inflation, which is eating away at the purchasing power of your money. In real terms, if you're not getting a return of 2% of more on your money, then you're actually losing money. So that million in the bank will only be worth £980,000 next year. Yes, £20,000 dropping off the value in a single year, and then it continues. 960, 941, 922, 903, and after just 5 years, the buying power of your money will have reduced by nearly £100,000 because the price of things goes up each year in the shops. So despite the fact the bank statement still says £1 million, it's not going to buy you as much stuff. And this is why we don't leave money in the bank that we're going to need long term. Keep watching to find out how to beat low interest rates and inflation, and I'd love it if you could let me know in the comments, what would you do with the money if you won the lottery? Tell me below. So yes, we might keep money we'll need for the next few years in savings, like your tax money or your emergency savings. But the rest of our monthly surplus income needs to be invested so that it grows to match or beat inflation, which done in the right way can mean that one day you do get to live off the growth. Like my client Deborah, who draws £24,000 a year from her investments. But the pot is still worth more this year than last year, because the pot is growing at 7.5% after fees and charges, in a reasonably cautious fund. So she's only taking out the growth and leaving the original investment to grow. This probably leaves you wondering how big her pot of investments is. It's around £500,000, which is totally within reach of so many business owners. But you'll need to know how to choose how much to invest and to put it in what. If you put £40,000 as a lump plus £500 a month in for 20 years, you could have £726,000 at a growth rate of about 7.2%. And £500 a month is only 6% of your £1,000 income. If you were an employee, you and your employer would be paying in 8% on an auto-enrolment scheme like Next. So you've only put in £160,000. The other £366 is your compounded growth. £160,000 into a well-diversified, tax-efficient portfolio without taking unnecessary risk and jumping on the latest bandwagon. As Warren Buffett said, nobody wants to get rich slowly, but what's the point of taking more risk than you need to and end up sitting on the edge of your seat desperately hoping that your life savings won't go up in smoke? Or is that better than being eaten away by inflation, just sitting in your company bank account doing nothing? You've made and are making this incredible amount of money, and now it's time to put it to work for you. Once you clearly understand how much you need to put away and the options available, you can then choose to self-invest your money once we've found the product you're comfortable with. Or you can ask me in my FCA regulated capacity to set things up for you, because I'm a qualified financial advisor trusted to look after over £4 million worth of client assets. The choice is yours. Okay, time for today's Ask Claire question, which comes from Ceri. I'm very careful to make ethical choices in my everyday life. How can I make sure any investments I make will be with companies that share my values? Well, the answer is that all investment funds now have to declare an ESG rating, which tells you how committed they are to ethical, sustainable and governance factors. You can find this out from your provider or from your financial advisor and use this to make a choice on whether your money is in the type of fund you're happy with. I hope this has helped you to take one step closer to that life you really want. So keep watching.